So there's something that's very, very essential to making money in the market, whether you're a trader or a longer term investor. It's a simple concept that you must understand and focus on when making your trading decisions. And this week, I'm going to explain what it is and show you that concept in action. And then, as always, we'll do the analysis of the markets, figure out where stocks are likely to go, talk about interest rates, gold, oil, and then finally, look at the trade of the week on a very hot stock this past week. HOLO is the symbol, and I'll show you how well it did. That's all coming up in this week's Stockscores Market Minutes. So what is the key to successful trading? Well, it's all about understanding the relationship between potential reward on the trades and investments you make and the risk, and having a situation where that risk-reward relationship is out of balance. In other words, you don't want to risk $1 to make $1. You want to risk $1 to maybe make $4. But it's more than that. It's also about understanding the probabilities of success. And so you want to buy when the probabilities are in your favor. Hopefully the probability of success on a trade is 60, 70%. And then not only that, but if the upside is $3 for $1 of downside and you have a 70% probability of success, then obviously that makes a lot of sense. And I'm going to show you in a moment on a chart how you know where the probability is better, and I'll show you also how to assess what the risk is versus the potential reward. If you can understand these concepts well, it's not very difficult actually, then over the long term you can be successful. But one of the key things to this is understanding that trading isn't about how well you do on one trade. It's about how well you do on 100 trades or 50 trades. And you have to be very careful not to get caught up in trying to maximize your performance on any one trade. You really want to maximize your performance over a large number of trades, and your approach should show that. So let's take a look at a chart that kind of captures this really well. This is a stock that I traded on Friday, and there's a few times on this chart when there was a buy point where the risk-reward relationship was what we call asymmetric. And let me show you why. All right, so let's just look at this one first. Here you have this little downward trend line. This is a 1-minute chart, so it's very short term. This stock was very actively traded on Friday, and so you can trade stocks like this on a very short-term time frame because it's so actively traded. So right here, we have the Stockscores action candle firing. That's that little yellow dot. And it was breaking a pullback, and it had formed a rising bottom from the previous low. So that meant that the probability of success was quite high. I'm going to say, given that the upward momentum was in place, given the break from low volatility from a rising bottom, it was between 60 and 70%. Okay? But more importantly, the upside was considerably less than the downside, because at that point the stock was breaking through resistance, and therefore it didn't have anything to hold it back. The resistance line was this little downward trend line. It was breaking that, and so it's got all this upside. But we also know that not every trade's going to work, and so we know that we have to have our buy point, which we'll do there, and then we have to have our stop loss point, which I always like to do just below the last low. So we'll draw that in red. So that difference represents our risk. Now the reward potential doesn't have a limit. It's got lots of upside potential. We don't really know what it is, but we know that it's not limited to something less than 2 times this. So this is our risk. I want my upside potential to always be at least 2 times. Now, because I don't see any resistance on this chart, I know that it's at least 2 times. My probability is 60 to 70% based on this pattern, and having done testing, I know that. And so that is a situation where I've got what we call a high present or a high probability of success, a high expected value on the trade. And as it turns out, this trade made almost 4 times its risk amount. There's the risk amount, and this is a reward of 1, this is a reward of 2, 3, and 4. And the sell signal came right here, and that was about 2.5 times risk. So that was the kind of trade we love to see. Now we're going to stick with this chart because I want to show you some things. When you're trading, it's not about trading the stock. It's not about trading the story. It's about trading the situation. You know, the stock, the story, whatever's driving this stock to go up on Friday, that didn't change all day. The stock was always the same. The story was always the same. But what changes is the situation. So let me show you what that means. I could have bought the same stock up here as opposed to down here. But look what happens. We always want to put our stop loss point just below the low of the last inflection point. Well, the last inflection point is way down here. When I say inflection point, what I mean is the point where the stock stops going down and starts going up. So now you see that the difference between the entry price and the support price is a lot wider than it was here. In fact, it's 2 times as wide. What that means then is that the upside, where the stock actually got stuck, was only 1 times risk. Because this was the risk on this later entry, whereas on the first entry it was much narrower. And so the situation was better because the trend was just starting. The breakout from that low volatility was just starting. And so you're much closer to an inflection point. Now I'll show you the point that I actually bought this stock. I bought this stock right here because it made this little move up, a very short pullback. We call this a hit and run strategy that I teach my students. And buying here, support there, and look at the upside in this case. 1, 2, 3, 4, 5, 6. It made 7 times risk. Now I will tell you that the probability of success on this breakout was probably only 50 to 60%, just because the pattern wasn't as long. It's not as well defined of a trend line as we had here. So here I thought it was somewhere between 60 and 70, and here 50 to 60. But if we have a 50% chance of making 7, that's actually better than a 70% chance of making 4. Right? Because a 70% chance of making 4 has an expected value of 2.8. And a 50% chance of making 7 has an expected value of 3.5. But what I do not want to do is buy the stock when it runs away from its trend line, because then my probability of success is lower, but also my risk-reward trade-off is so much wider. And so again, we're trading the situation, not the stock. And that's an important thing to think about. It's one of the keys to successful investing that I don't think most people really appreciate. When you go into a trade, think about what's my upside versus my downside and try to get a sense of the probability of success. All right, let's take a look at the markets. We had decent markets last week. I wouldn't say fantastic, but they were pretty good. Let's take a look at the S&P 500. Now, early in the week, we had this drop in the market, which was caused by the CPI, the CPI number that came out. And that was a little better than expected, which made investors concerned about interest rates and inflation. And so we had that little gap down. However, the upward trend was not broken. And so as long as the upward trend isn't broken, the news headlines, no matter how negative they might seem to be, don't really matter. We want to see a trend line get broken as a sell signal. Well, that didn't happen on the S&P. So looking at the 1-month chart, trend is up. Buyers are in control. No reason to be a seller yet. On the 3-year chart, trend is up. It's getting a little extended. You know, see how steep this upward trend is on the S&P. Whereas here's your trend line. You're getting quite far above it. And so I think the S&P is certainly ripe for a pullback, but there's no sign of one yet. Until there's a sign of one, we just ride the trend. Don't try to make sense of it. Don't try to argue with how the market is wrong. Sell when there's a sell signal. I know a lot of people say, oh, the market's way overextended. Maybe, but There's no reason to sell yet. So wait for that, and it hasn't happened yet. Let's take a look at the NASDAQ. Now, as we've talked in recent weeks, remember that these indexes are heavily weighted by the large cap tech stocks, which make up the index. Here's the short-term chart of the NASDAQ, and you can see that despite the downward move there, we haven't broken the upward trend. And so the trend is up, therefore bullish. 3-year chart, same thing, still in a bullish trend. Again, ripe for a pullback like we had here, but there's no sign of one yet. See here how this upward trend line was broken there? That would be a sign to sell. And it was good because for the next 4 months, the market went down. We don't have that yet. We did close below the open this past week on the NASDAQ. And so that's a potential reason that we'll get more weakness, but we still haven't seen it. I want to take a look at the small cap stocks. And this is a broader market index in terms of it being 2,000 stocks without a heavy weighting of any, large cap stock like Apple or Amazon, Microsoft. And so this is a better indication of what the market is doing actually. And so here you see rising bottoms, quite a bit of volatility this past week, which means investor uncertainty is a little higher. Right at resistance, has optimism building. I think we'll get a breakout through this level soon, but it hasn't happened yet. And when we go to the 3-year chart, you can see that this price level at 205 roughly is quite important because there's that long-term resistance. We bumped up against it many times and it's trying to get through now. It's built the rising bottom. I think we're likely to break out, likely that the small cap stocks will do well, but it hasn't happened yet. So we'll watch. Maybe next week we'll get that breakout. All right, moving along, let's look at the Canadian market, T.XIU. And the Canadian market broke to new highs, local highs here. Looking at the 3-year chart, you can see that it still has the all-time highs way up there. And there's still upside for the Canadian market until it hits resistance, certainly underperforming the US markets. And it has been that way for a long time, at least a year, maybe 2 years. And that's largely because of commodities. So let's jump to the commodity charts. GLD is the symbol. In the short term, if we look at the 1-month chart, you can see that the trend for gold is generally down. There's falling tops, which means the sellers are in control of gold in the short term. But in the longer term, the 3-year chart, the trend is generally up. You get a little overextended, you pull back. You get a little overextended, we're working on a pullback. And so I'd be thinking about being a buyer of gold and gold stocks down in here as opposed to up here, because I think it's more likely that we're going to move down than up. How about oil? USO is the symbol. And you can see that oil is slowly getting better. Step 1 was the break of the downward trend line. That happened in the middle of January. Step 2 is builds of rising bottoms, which we've had. And now we're starting to tickle our way through this resistance level. So it's not a clear-cut break yet. You can see the Stockscores are better. They've been, below 60 since November. And they're starting to creep up a little bit, and that's because this chart is improving. So oil is improving. It's not outstanding, but I think you can start to look for opportunities in the energy market. All right, let's move along to currencies. We'll start with the US dollar. And you can see it has been moving up. I'll show you why in a minute, but the US dollar has been moving up. And so depending on where you live, that could be a good or bad thing. If you're trying to buy goods in US dollars, and that's a bad thing because they're getting more expensive. Bitcoin has been very hot. And of course, we've been bullish on Bitcoin for a while. I'm not comfortable chasing it here because the reward for risk trade-off really doesn't make any sense. It's gone up a lot. I think it's a good hold, but I would dance close to the exit door because someone may yell fire soon and then there's going to be a bit of a pullback in it. But for now, remains a hold. How about the bond market? This is the one that is driving the US dollar. So you can see the bond market has been moving down. That means interest rates have been moving up. That makes it more attractive to buy US dollar assets like bonds because the interest rates are rising, so you get a better return. And that's one of the reasons the US dollar has been rising. So this is an important chart for stocks, in particular for the small cap or the broader market, because they're much more sensitive to interest rates. And if interest rates are going down, the market's going to go up? Well, the last 2 months, 7 weeks, interest rates have been rising in the bond market, and that's hurt the stocks a little bit. But to be quite frank, the stocks haven't been hurt as much as the bond market would predict. And that tells me that expectations are slowly moving toward a better interest rate environment. So my ratings then, bullish on both time frames for large cap US stocks and the NASDAQ. Small cap stocks now short-term bullish, it's slowly improving, long-term neutral. Canadian stocks bullish on both time frames, gold bearish in the short term, neutral in the long term. Oil neutral on both time frames, but improving. That could go short-term bullish soon. US dollar short-term bullish, long-term neutral. Bitcoin bullish on both time frames, and bonds bearish on both time frames. All right, well, let's look at a swing trade from this past week. This is a stock that really had a great week, and I'll show you the point where we were buyers of this stock in our Stockscores Active Live service. I have a strategy called an Alpha Echo, and the way this strategy works is we look for stocks that are hot. We then wait for them to cool off a little bit, but they still have that alpha, that signs of excitement in the market. And when they start to move again with some abnormal activity, we buy them. And so this little yellow dot is my Stockscores action candle indicator. It's my own concoction. It looks for statistically significant abnormal price and volume action. And so you can see this stock was abnormal on February 7th, very actively traded. And then it goes quiet and then it perks up. And I love that. And so we have some algorithms running, scanning the entire US market in real time all day long, and it finds it in real time. So buy it there. It got up to 3 times risk, then pulled back, and then really went ballistic into Thursday and Friday. And Friday, big gains. And so ultimately, this got up to 13 or 14 times risk. So thinking back to our risk-reward trade-off concept that we talked about at the top of the video, here you've got a stock that had a 60% chance of working, a trade, 60% chance of working, but it made 12, 13 times the risk. Risk $1, make $12. That's the kind of trades we love to have. And those are the kind of trades that you can get from small cap companies that are trading very strong volume, particularly if they have a low number of shares in the float. And maybe we'll talk about that in a future episode of the Stockscores Market Minutes. Well, let me know if you enjoyed this video. Click on the like button, leave a comment, but most importantly, trade well.